Hello. Today we are going to learn how to build financial models to value common stock. The key focus of this video is on free cash flow valuation. The value of a share of common stock is equal to the present value of all future cash flows that it is expected to provide. This topic is highly relevant in the world of investment. You can make use of the knowledge to perform equity analysis. If the stock is selling below its estimated fair value, you may buy the stock. If the market price is above its fair value, you may sell it. Without further delay, let's learn together. The free cash flow valuation model is a model that determines the value of an entire company as the present value of its expected free cash flows discounted at the firm's weighted average cost of capital. This approach is appealing when one is valuing firms that have no dividend history, or firms that are startups, or when one is valuing an operating unit or division of a larger public company. This method is also known as the discounted cash flow method of valuation. Free cash flow is the cash produced from the business operation of the firm. Free cash flows represent the amount of cash flow available to investors. Investors include debt holders and equity owners. These two parties are the providers of capital to firms. If you refer to different finance textbooks, different authors may use a slightly different concept of free cash flow. I hereby list out the formula from three different authors. You may focus on Benninga's version for the purpose of this course, as we are using Benninga's textbook as the main reference. Let's interpret Benninga's formula. We add depreciation because depreciation is a non-cash expense that would not reduce the free cash flow of a company. We deduct increase in net working capital from profit after tax, as such items can reduce free cash flow. Net working capital involves changes in current asset and current liability. Lastly, increase in capital expenditure, such as purchase of fixed asset, reduces free cash flow and should be deducted. The input of free cash flow can be collected from the income statement or the cash flow statement. Can free cash flow be negative? Yes, free cash flow can be negative for rapidly growing business. Free cash flow is the amount of cash that a firm can pay out to investors after paying all investment necessary for growth. The weighted average cost of capital is the average funding cost for a firm. WACC is widely used as a discount rate for capital budgeting purpose. It is used to discount future cash flow to find present value. WACC reflects the entirety of the firm's financing activities. WACC is found by weighting the cost of each specific type of capital by its proportion or weights in the firm's capital structure. The weights must be non-negative and sum to 1. WACC must account for all financing costs within the firm's capital structure. In this formula, E stands for equity, D stands for debt, T stands for tax. The cost of debt is adjusted for tax because debt financing provides tax shield to a firm. Therefore, the after-tax cost of debt is calculated. In finance theory, the enterprise value of a company's debt and equity is the value of its free cash flows discounted at its weighted average cost of capital. The enterprise value represents the value today of the cash flows produced by the firm's future business activities. The present value of the firm's future free cash flow is often called the firm's enterprise value. The enterprise value is multiplied with 1 plus WACC power of 0.5 because we have to correct for the fact that free cash flow occurs throughout the year. After we have calculated the enterprise value, we need to add enterprise value with cash balance in the company to derive the total asset value. Total asset value consists of equity value and debt value. Therefore, to calculate equity value, we minus debt value from total asset value. Finally, we divide equity value with the number of shares outstanding to obtain share price or fair value per share. In this learning session, we consider two types of free cash flow valuation models, the constant growth model and the variable growth model. Let's learn together. The constant growth free cash flow valuation model is similar to the Gordon growth formula. We discount the future free cash flows with weighted average cost of capital and adjusted for a constant growth rate. Here is the formula. Let's look into an example. This example is about constant growth model. The latest free cash flow of the company as of 31st December 2019 is 10 million. The future anticipated growth rate of free cash flow is 8% annually. Weighted average cost of capital is 12%. There are 30 million debts and 2 million cash in the company. The number of shares outstanding is 20 million. This financial model shows the valuation of stock using free cash flow with constant growth rate. First, I type all the given information as input. I highlight the input in gray. In financial modeling, it is good to separate the input and output. Here is the output. And subsequently, when we change the input, the output will be adjusted automatically. Next, we can calculate the enterprise value using the formula given here. This is the formula. I can also separate the formula to calculate enterprise value assuming cash flow occurs at the end of the year. After that, I multiply the answer with 1 plus WACC power of 0.5 to obtain enterprise value assuming cash flow occurs throughout the year. As you see, both answers are the same. Next, we shall calculate value of equity. The value of equity is enterprise value add cash, subtract debts. Finally, we calculate the share value by dividing the value of equity with number of shares outstanding. And this is the final answer, the share price. In the real world, future growth rates might shift up or down because of changing business conditions. It is useful to consider a variable growth model that allows for a change in the growth rate. In this model, we assume a single shift in growth rates occur at the end of year end, and we will use G1 to represent the initial growth rate and G2 for the growth rate after the shift. In this model, there is a need to calculate terminal value. Valuation using the discounted cash flow method in principle requires us to project an infinite number of future free cash flows. But in practice, we can only project up to a limited number of years. A solution to this problem is to define the firm's terminal value as the firm value at the end of year end. Instead of projecting the present value of each of the cash flows to infinity, we summarize them in the present value of the terminal value. Terminal value is what we project the firm to be worth at the end of the projection horizon. Take a look at this formula. This formula requires us to estimate the long-term free cash flow growth rate. An important consideration is the long-term growth rate should be close to the overall economy and represents the sustainable growth rate. The formula to estimate the terminal value is similar to the Gordon growth model. In this example, we are going to calculate the share price based on free cash flow valuation model. Here we assume a variable growth rate. In this example, I'm going to show you how to value a common stock using free cash flow model based on variable growth rate. The input is given in the blue table. The free cash flow for the current year 2019 is 1 million. I shall type equal, point this cell for 1 million. The free cash flow for year 1 or 2020 will be equals to last year cash flow multiplied with 1 plus growth rate. The initial growth rate is 20%. Alright, so I'm going to point 20% and close bracket. Take note that I will put a string here. I shall type F4 to fix the cell, fix the reference cell to the initial growth rate. And here is the answer. The free cash flow for year 1 will be last year free cash flow grow at 20%. As we know, the cash flow will grow at 20% for the first 5 years. Therefore, I'm going to drag my answer all the way down until here. But for year 6, the cash flow will be stabilized at 5% growth rate. Therefore, this free cash flow will be equal free cash flow of previous year multiplied with 1 plus constant growth rate of 5%. Close bracket. And here is the answer. Next, I shall calculate the discounted cash flow for the future years. For year 1, the discounted cash flow will be equal the free cash flow divided by 1 plus WACC 12%, which is the discount rate, close bracket, power of T, which is 1 year. Alright, I shall again fix the cell for WACC. I press F4 to fix the reference point. And this is the discounted cash flow. I do not need to perform it for all the other cash flow. I can drag down the answer up to year 5. And Excel will automatically calculate the answer. Next, I shall calculate the terminal value in year 5. Terminal value in year 5 represent the cash flow in year 6 divided by weighted average cost of capital minus the constant growth rate. This is a Gordon growth model whereby we assume cash flow will continuously grow at 5% after year 5. And this is the terminal value in year 5. For this figure, I shall discount it into present value as well. I will type equal the free cash flow divided by 1 plus WACC, close bracket, power of 5. And this is the discounted present value for the terminal value in year 5. Next, I shall total all the discounted cash flow. So I type equal SUM, open bracket, and highlight all the cell here, close bracket. And this is the total discounted free cash flow. Next, I shall calculate the enterprise value. I shall adjust the enterprise value to reflect cash flow that occurs throughout the year. Alright, Therefore, I'm going to type equal the sum of the cash flow multiply with 1 plus weighted average cost of capital, close bracket, power of 0.5. And here is the answer. Alright, next I shall take the cash value from above, from the input. I shall type equal cash, point this cell. I shall also take the debt value from the input, equal debt. The value of equity is equal to enterprise value plus cash minus debt. And here is the answer. There are 2 million shares outstanding. Therefore, I shall type equal and point the input cell. Next, I shall calculate the share price, which is equal value of equity divided by number of shares outstanding. And here we have the share price. This is the final answer. Finally, we have come to the end of this video. Thank you for watching this video. Please practice the examples given in the Excel spreadsheet as practice makes perfect. I hope to see you again. Bye.